Muy buenos días. Good morning, good afternoon to everyone from Santiago de Chile. I'm the head of the Public Unit Information from ECLAC, and we want to give you a warm welcome to this press conference where we will show the preliminary overview of the economies of Latin America and the Caribbean 2022, which is being done both face-to-face, in person, and also online through the Zoom platform and livecepal.org, also the YouTube channel, our website, and also our platforms, Twitter, Facebook, and other public media. We would like to welcome all of the people that are with us today, the room Celso Furtado, in the headquarters of ECLAC, especially the colleagues from the media, in particular, those who have registered for the follow-up of these, whether it is in person or also online. It will be delivered by José Manuel Salazar-Xirinachs, who is also with the director of the development unit from our institution, Daniel Titelman, the person responsible for putting together this report. We also have with us the head of staff, Silvia Hernandez, and the officials of the economic area, Cecilia Vera, Ramón Pineda, Noel Pérez, and Esteban Pérez. So after the presentation, we will open it up for questions and answers by the journalists. We would like to remind the accredited members of the media that are online that they can submit their questions in the Zoom chat pod, or also the email that has been appointed, conferencia prensa cepal.org, in order to make sure that we get the corresponding questions. The Executive Secretary of ECLAC, José Manuel Salazar, the floor is yours, sir. Thank you so much, Guido. Good morning, everybody, especially those that are here present, but also those who are connected, listening to us. This is the last report out of several that we have launched in the last few months, and it's a key one on the situation in Latin America, a preliminary overview of the economies of Latin America and the Caribbean. I would like to thank Mr. Titelman and all his team from the Economic Development Department at ECLAC. Obviously, this is collective work, and it has everything related to the statistics, which is critical here as well as in the other reports. And also, I would like to thank the information that we have received from the offices from the different countries coming from Mexico all the way to the Caribbean. As you can see in this report, we have 8 chapters, and it starts with the international context, then one on the evolution of liquidity, then one on the external sector, economic entities worldwide and also regional, internal price, revenue, salaries, fiscal policy, and economic perspectives on what 2023 is looking like. We're not going to cover all of those points in detail, but we will deliver the most important messages are these. So the most general or most important messages stemming from this report, as you have already heard before, the cascade of the crisis has led to a complex and uncertain global scenario. There is a slowdown, both in global growth as well as that in trade in 2022, and we see that going on in 2023. A relatively good news is that there is already a lower inflation that will tend to moderate monetary policy rate increases by the major central banks. And if you want an example of this, that we hope will continue, is that yesterday the Federal Reserve of the United States, instead of increasing 0.75 points, it only went up 0.5 points, and we expect that given the signs that we have seen regarding inflation that we're going to look at into detail, that probably the increase will start moderating. It doesn't mean that it will be a decrease, but it will simply slow down. So increases in financial volatility and a greater risk aversion. This is something that that the countries will probably have to go through the interest rates for the debts and also for the purchasing or acquisition of new debts. And also there is a depreciation level of currencies and a certain instability and appreciation of the dollar in this environment of a higher financial volatility. And also there is lower capital flows towards the emerging economies, including Latin America and the Caribbean, which obviously aggregates or adds up on top of the financial restrictions and also when it comes to debt in general. So here you can see the growth prognosis of the economic activity for the world on the left, and then you can see in each of these groups with these bars, the most advanced economies, United States, Japan, and others. For the world, it went from 6% in average, the important rebound effect of 2021 to 3.1 and 2.6 is expected in 2023. That is the slowdown of the world economy. You can also check several of these. I would like to talk about the most important commercial partners of Latin America, because these are the ones that if they were to grow at a high rate, then that would give us some tailwind and would give us some momentum. But if it's a small rate, then that's not helping to the exports trade market of Latin America. We can see for the United States, the forecast for 2022 is 1.9 and a slowdown 0.7 in 2023. Eurozone, another important commercial partner or ally, will close 2022 with 3.2 growth, and it is expected that its growth will be 0.3 in 2023. And that's very concerning for the Europeans and Europe, but also because of the low dynamics for exports from Latin America and the Caribbean towards Europe. And obviously that growth rate for Europe implies that there are several countries that are going to be suffering a contraction. And China does grow a little bit. The good news is that and it has been already in the international press, China will be finishing with a smaller growth rate than one was originally expected, only 3.3 in 22 for several reasons, including the zero tolerance COVID policy, but also other topics regarding the real estate market and also the Chinese financial system. That is the smallest growth rate in China in 4 decades. And for China, it's very bad news. In the coming year, we foresee a 4.4 growth rate, but still that is a rate that if we compare to the historical levels of China is very low. You can see the other countries that are there too. So world trade also slows down. You can see here an important rebound effect in 2021 and an important slowdown to 3.5 in 2022 and a forecast of only 1% in 2023. It's a completely different dimension, but this just goes to show that economically speaking, next year is going to be very difficult for the world and for Latin America. In terms of inflation, in the last months, if you look at the graph on the left, you have the price index for some basic products, food stuff, fertilizers, metals, minerals. And you can see how these prices have been adjusted with a downward trend. You can also see the graph in the middle and the pressure in the world supply chains. There is the pressure index, the global supply chain pressure index, which includes several calculations like the cost of transportation, delaying delivery, level of stock for the companies, and all of that is consolidated in one index, which shows that the pressure decreases, but still disruption and pressure levels that are higher than prior to the pandemic. So there are relatively good news that we can see in the forecasts for inflation. For example, worldwide, after being at an average of 3.7 in the decade going from 2010 to 2019, 8.8 in 2022, and 6.5 for 2023. The more advanced economies, 7.2 and 4.4. So we can see that there is a growth there and a peak at 7.2 from 2022 after a average rate in the previous decade and a small decrease to 4.4 emerging economies 8.1 and the eurozone from 8.3 to 5.7 and Latin American and the Caribbean from 7.3, which is what's expected, to 4.8. So given the reasons, among others, that we can see here on the graphs on the left regarding the behavior of basic products and the offer, the supply, sorry, as well as a normalization in the supply chains, that is part of it, but also given the increase in the interest rate and the restrictive monetary policy, which has an impact on demand because this is a combination of both supply and demand factors. So relatively good news, and if we say relatively, because still you can see here the forecast for 2023, and all the figures are higher than the inflation rates that we had in the previous decade. So there is an improvement when compared against 21 and 22, yet we don't get to the pre-pandemic levels. Also, the increase in inflation pressure, and one of the episodes where the monetary policy has been synchronized internationally. When we say that it has been synchronized, it's because they happened simultaneously. It happened simultaneously in many countries. It doesn't mean that it was coordinated, and that's a very important point to keep in mind. But it is one of the episodes that is more synchronic in that sense, both internationally and in the last 5 decades. It is the largest amount of monetary policy rate spikes since the 70s. And you can see on the left the increases and decreases, and you can see in the last period in 2022, it has been a huge, there has been a huge synchronization of spikes. And then on the graph that's in the middle, you can also see the steps of increases, as the case of the United States. The last one, which took place yesterday, is 0.5. So it is expected, given the inflation figures that we have seen, that the central banks will then start slowing down that increase. But this is keeping in mind that we don't have a crystal ball and there is still uncertainty. And with all of the elements that are impacting the world economy, there could be a change. There is a forecast there, an estimation on what the behavior of the rate in general terms of the Federal Reserve and also from the European Central Bank. And another important point here is an important drop in liquidity. Because as you might imagine, in terms of monetary policy, there is the interest rate on the one hand, but the other instrument that has been strongly used is the balance sheet, the size of the balance sheet as a non-conventional monetary policy instrument. And there we can see a very important reduction of global liquidity, with central banks no longer buying bonds, and therefore they are moving away from the quantitative issue. So they are they expect though that there will be that these are going to be the financial conditions. On the left on this graph, we have three indexes of volatility that have increased, and they remain high both in developed countries as well as in emerging economies. And on the right-hand side, the risk appetite has decreased, and that's what that graph goes to show. The exits of capital flows, the outflows of capital flows in May 22, we can see that the outflows from emerging markets have intensified in 2022, and this has also gone hand in hand with an appreciation of the dollar. The financing costs are increasing in the fixed income. The long-term bonds for fixed income markets, these are considered as the benchmark of the United States and Germany, and they have risen sharply due to the inflationary pressures and also the consequent tighter monetary policy. The higher bond yields of those bonds that you can see in this graph, together with the lower risk appetite, has been passed on to the cost of financing for the rest of the economies. In Europe, for example, you can see the graph in the middle. The yields have increased, and these increasing costs of global debt have increased also the financial stress risk in some emerging markets and developing economies, which over the past decade have accumulated debt at the fastest pace in more than half a century. And as you can see, the graph on the right, the EMBI, the Emerging Market Bond Index of sovereign risk, has increased for emerging countries significantly in 2022. That index reflects the financing cost, also the spreads that are paid when they issue and they place financial instruments in the markets. And this is one of the measures of country risk. So for the region, in 2023, growth, there are basically two conclusions here. One is that lower inflation will tend to moderate monetary policy rate increases, and international financial volatility increases the risk of exchange rate depreciation, which would affect the trajectory of inflation. And a couple of then suggestions regarding actions, but we will be talking about this right away, which is the importance of expanding fiscal space in order to provide sustainability for increased demands for social spending. The important thing here is to continue funding these social expenditures in this social crisis that we have seen in the document that we launched 2 weeks ago, but also public investment that we know has dropped tremendously. So this is a message to try and avoid premature fiscal adjustments. And then the other one is to balance the challenges imposed in the long term by macroeconomic restrictions. Because there, the complex thing that countries and governments have, especially the monetary and financial authorities, is that to find the balance between macroeconomic restrictions, like the ones that we have characterized, and also the need of making growth more dynamic, reactivating economies, decreasing poverty, inequality, and others, on also increasing investment and addressing climate change. If we focus then, this has been the economy, the general context, and we can look at the region. So here in Latin America, we can see that the quarterly dynamics in 2022 shows a slowdown that was very clear in the third quarter, and this is a process that is generalized in the countries in Latin America, and we can see that slowdown is expected to continue in 2023.
And here we are able to notice the slowdown in all components of aggregate demand, on all. That is why it's so strong, because it's in all components. The private consumption in blue was a motor for the recovery. And then we see the 2020, the first quarter, and then the second quarter that goes up, but that stopped in the second semester of 21. And then there's a downward trend. The same with investment, especially construction, machinery, equipment, that's on grade. Public consumption has a similar behavior, although a little softer, and it goes up and then down. And exports, you can see what's happening the second semester. of 21. All components, there's no component that may be helping out to boost economic activity. And here we have the big picture for 2022, the summary. Let us take a look then at 2023 with growth estimations per country for Latin America and the Caribbean and the Caribbean. Estimation says that Latin America and the Caribbean at an average will end up the year with 3.7. You can see the differences. They're not much. Latin America, the Caribbean 3.7, Caribbean. And here we see per country, Central America countries, Mexico 3.3, only Central America 4.2, etc. And here we see the average for Caribbean 4.5, excluding Guyana. But it must be considered because it has an extraordinary growth rate because of oil. And that, I would say, may distort the averages. And here we have for 23, where we expect 1.3 growth. Unfortunately, that is equivalent to a third of the growth of the current year. So it's a very strong slowdown. And here we have the detail per country. And there are bad news for Haiti and Chile. These are the countries where the estimation for growth is negative. Now, for the next year, we anticipate less inflation. You can see in the graph on the left, it goes down next year, but it's still we'll have a stronger inflation than before the pandemic. That has to do with the behavior of inflation throughout the globe. On the right graph, you see the rates of the core components that has to do with CPI. Energy has been two of the elements that have gotten CPI to go up, but with different dynamics. And here we can see different months and different periods of time. There is a track of going up since 2019, whereas energy, the growth comes as of March 21. This shows data of the synchronized but not coordinated monetary policy hikes. In Latin America, you can see that in Brazil, the rate was of 2%, and 9 December 22, 13.7, with 5 rises during that period. Chile of 0.5 in 20, up to 11.25 in October 22, with 7 hikes during that period. And the last figure is the total variation. Mexico from 4 to 10, Peru from 0.25 goes up to 7.50, Uruguay from 4.5 to 11.25, and Costa Rica 0.75 to 9. In most cases, 5 hikes, 9 up to even 12 hikes in Peru. Financial flows toward Latin America have been reduced. Here we have an indirect calculation that is made by ECLAC on the left, and on the right, we have that for Latin America and the Caribbean. As I already said, this is a sovereign risk index that is higher and with a growing track. Greatest exchange rate volatility and currency depreciation have required more use of foreign reserves. On the left, we have variations of the exchange rate vis-a-vis the dollar. And we have Brazil, Chile, Colombia, Mexico, countries where there was a depreciation vis-a-vis the dollar. And for Peru and Uruguay, there was an appreciation. Naturally, there are interventions made by the central banks, and there is a trend since 2021, the second semester, to see a reduction of foreign reserves. But we have an average line from 2010 to 19 of the reserves in the countries. And we can see that even though there's a reduction, we're far from entering risk zones during this period. And even though the reserves have diminished, still the countries are able to face the needs of funding, taking a hold of their reserves for Latin America and the Caribbean. Fiscal deficit. And now we have fiscal deficit for Latin America, and we'll see later for Caribbean. The values are close to the period before pandemic. This is on the left, but the public debt on the right is still high, even though the trend is to see a reduction. In the left, we see that the primary result, which is the orange dot inside the green bar, the primary result of 0.5 of GDP as an average for 22. And this is a result, as you can see in the red line, of a reduction in the expenditure, and in blue, an increase in revenue. But this is a contrast. If you see in 21 and 22, there's a contrast between 21 because during that year, both contributed to the reduction of expenses and increase in revenue. But 22, here we have the greatest contribution because of the decrease in expenditure. Now, taking a look at the debt, there are 2 years of consecutive drop in the indicator public debt and GDP. That is due to discipline, expenses, and the recovery of economic activity. But the average estimated by September 22, 51%. Caribbean. And these are similar graphs, but this is information for the Caribbean. The primary expense is lower, 0.2 vis-a-vis 0.8 in 21 and 3.9 in 2020. The result for 21, we can see in red there was a reduction in expenditure, but an increase in revenue. But the difference here is that in the Caribbean, we see a drop in tax collection in 22. On the right, we see a drop in 22. This indicator public debt, gross public debt of central bank over GDP. But what's important to note here is that the differential between the graph from Latin America and the data for the Caribbean is that the Caribbean is almost 30% above Latin America in this indicator. And that is a tremendous challenge for the Caribbean countries. It has much to do with the natural disasters and investment costs in construction because of the higher cost from natural disasters. Subsidies. And here we have the interannual variation, and on the right we see an index of levels. Subsidies and transfer trends are uneven here. In 2021, these are the light blue columns. We see that there are cuts. 2021, there were cuts comparing to in 2020, but still they are at levels above 2019. And in looking at the dynamics for 22, these are the orange colors in orange. There are subsidies and transfers in many countries, and the cuts in 21 are due to a withdrawal of subsidies, and the transfers went up a lot in social relief policies to fight COVID. And these were withdrawn in 21, and the increase in 22 are disbursements also because of the need that is still on for bonuses. And we heard that there are 56 million persons that are hungry in Latin America. So we see the need to increase or to maintain these cash transfers for social relief. But in 22, we see that the increase is also due to anti-inflationary measures and because of fuel prices. And there are other energy subsidies as well involved. So this is, shall we say, what we are able to see in these last 2 or 3 years in terms of subsidies and transfers. The increase in interest rate payments. Here we see in green are interest payment that are on the rise in the last decade. And we also see expenses in health, especially the rise because of the pandemic. But this has brought a cost because, well, the hospital expenses have gone down even lower in 2020. These are the structural adjustments in fiscal issues, and this has been imposed on us because of the situation. Now we take a look at the recovery of labor markets that is still slow and uneven. We have 4 indicators: total unemployment rate, participation, informality, and average wages. These are very important, 4 important indicators. The first line, unemployment rates, you can see how unemployment went up. In 10.3 in 2020, went down in 7.3, and we expect that this will continue for 23. But with a very strong gender gap, as we can see here. If you look at total participation, that went from 59 in 2020 to 61 in 21, then 62 and 63 for next year. So there has been an increase in total participation. It's not much, but it's still significant. Once more, though, with strong gender gaps. Now, informality rate went from 48 to 46, and then it went up. But we must be careful because this reduction was due to the lockdowns during the pandemic. And this is not coming from the global markets, but because of the fact that the people stayed at home during the pandemic for a lot. So the return of 48.4 is the going back to the situation in 2019 before the pandemic. Now, average wages went down in 2020 strongly, went up a little because of the rebound 21. But unfortunately, in the current year, 22, once more there was a reduction. So there are mixed results in terms of labor markets. And to start wrapping up, we have already brought this on other occasions, and it's very important to go into the long term. And here we have a topic that brings to mind the lost decade of the 80s. And this is the graph from 51, has an average in orange for each decade. And you can see that in the 50s, 60s, and 70s, the average was 5.7, 5.8. Then we got to the lost decade because of the debt. And then we had 2 better decades. And the average of growth for the region was 2.7 and 2.0, but it's very little growth. This is not the type of growth that we need in Latin America to reduce informality rates, poverty, and to have better quality jobs.
So if we estimate it from 2014 to 2023, including that 1.4% of growth that we expect in average for 2023, in this decade that is finishing, and there's only 1 more year to go, growth is only 4.9. And that's exactly what we have been saying. It doesn't mean whether we're going to have a second decade that has lost. We're finishing the second decade lost. And the question is, whether there's going to be a third one, what's going to happen between now and 2030. So in sum, there are two important topics. The current one and the other one is the longer range one. Fiscally speaking, well, we have to avoid premature spending adjustments and expand the fiscal space like many countries are doing. Colombia went through an important reform, and they have created important fiscal space for social programs and others. And that can be done through the reduction of evasion and also having tax reforms that allow for better money collection, but also making progress in improving the efficiency and effectiveness of expenditure. There's a lot of work to be done. It's a very difficult task, but there's still a lot of room for improvements in matters related to efficiency, fiscal efficiency. And in the monetary financial area, it is important to diversify the toolbox, not to put everything on the most conventional instrument like the monetary policy, but there is microprudential and regulatory instruments that can give signals so that credits expand to certain sectors, so that, for example, housing or other sectors that are labor intensive, also SMEs and other technical areas with a reserve rate in order to improve access, especially to certain categories of small and mid-sized companies to credits and collaterals, and that's important. Also, reforms to the international financial architecture are required to advance mechanisms to facilitate eventual sovereign debt renegotiation. It's a big topic. And ECLAC has issued a few messages along these lines because it's important to mobilize more global liquidity and to strengthen the role of multilateral and regional lending institutions, not only for the lower income countries, but also for the mid-level countries. And it is essential to meet social demands, creating decent employment, reducing informality, inequality, and poverty. And there is a whole agenda of possible interventions. And looking at the mid and longer term, obviously, the reactivation, growth. Latin America is in this low growth trap, and it's been there for 40 years. And then the fighting inequality, addressing or tackling climate change. There's a whole agenda that we have presented in detail in several documents. That's what I had to share with you. Thank you very much. Thank you so much, dear Executive Secretary. So this is the presentation of the main contents of this yearly report on the preliminary overview of the economies of Latin America and the Caribbean 2022. So let us go to the press conference and the round of questions. And we will start a concern that we have received from Cecilia Barria from BBC World. And she's asking, dear Secretary Executive, on some of the topics that you have addressed during the presentation, what is then the horizon regarding inflation for 2023? Cecilia Barria from BBC asks about inflation for 2023. I want to basically go back to what we have already said in several of the graphs, especially how for 2 or 3 months, depending on the primary products that you want to take a look at, we have already seen that inflection point in terms of that growth, especially for foodstuff. The prices weigh so much in the basic basket, and it hits very hard on the lower deciles. That has turned around internationally, and it's already going into a reduction, but it's still higher to the levels prior to the pandemic. So what's expected is that inflation, and we've seen the specific amounts, the inflation will decrease not only worldwide, but also in the region. We have seen the figures that you have and the average for the region. So in terms of inflation, relatively good news, but that doesn't mean that we're going to go back to the inflation levels prior to the pandemic, the 10 years back to 2019, and then what happened in 2021, 22. So inflation in 2023 will be lower than that of 2022, but not as low as prior to the pandemic. The low inflation era is gone. And in 2023, and most likely in 2024, there will be a more moderate inflation than that of 21 and 22, but not as low as the one we had prior to the decade, in the decade prior to the pandemic. That's the answer that I have. Thank you so much, dear executive summary. Now, there are several concerns here that we have that have been submitted from different correspondents, and some of them are along the same lines, a similar type of concerns. So let me give the corresponding credit, though, but let me ask you, Maria Martinez Moore, correspondent from Chile, the EFE agency. She's asking about the impact of what's happening in Peru in the last few days and the GDP growth projection for the next year. So this is a very similar question to the one that asked Natalia Ramos. She was a correspondent from Reuters. How does the political crisis in Peru impact Chile, the largest copper producer in the world? So that is then the concerns regarding the political situation in Peru and the impact that it could have in Chile. Yes, I would like to ask Daniel Titelman to answer those two concerns. Yes, thank you so much, Executive Secretary. Regarding these concern, the projections that we have for the growth of Peru were done prior to the political events that have taken place in the last week. And yes, they do create more uncertainty, and we will have to see how they evolve, how this political situation turns out. But from the point of view of the estimation, they show, on the one hand, that they have the global economy dynamics, which is going to have larger uncertainties, a decrease in the price of commodities. In the case of Peru, that exports minerals, it has an important impact too. Also, in the case of Peru, we had also seen, as in other countries, a reduction in the private consumption, and that started strongly in the second semester this year. Therefore, the economic factors that are behind these projections will remain in terms of smaller aggregate demand, the decrease in the price of commodities, and we have to add on top of that the political uncertainty. From the point of view of our projections, these were done prior to the political event. But the basic message is that the guidelines of the evolution of the most important economic variables that are behind these projections will remain, and most likely we will have to see then how the political uncertainty can impact the behavior of these variables, which basically will impact investment, we believe, but we have to continue looking then at investment. So from that point of view, in April, we're going to be checking our forecast, and then we'll be able to tell you with more certainty how those political impacts have impacted their growth trajectory. Thank you very much, Mr. Tiedemann, Director of the Economic Development Department at ECLAC. And another question. Three of our colleagues from the media that are following this press conference have a similar kind of question. Maria Martinez Moore from EFE is asking that Chile, together with Haiti, are the only countries that will have a negative growth in 2023. Why? Natalia Ramos from Reuters is asking something very similar. Chile, together with Haiti, are the only countries in the region that has a drop, And why is this a drop in spite of the past recovery after the pandemic? And Orlando Mileto also from EPS is asking, how can you explain that Chile, together with Haiti, are the only countries in the region where the GDP will have a negative growth in 2023? So this is a situation that has called the attention of some of the media. So please, you may address this question. I would say that that is the figures that we get from the estimations. But aside from that, there's nothing else in common that Haiti uh, has in common with Chile. I mean, they are very, very different realities. Haiti, unfortunately, as you all will know, is a country that has been undergoing very serious structural problems, poverty, and has not been able to build a state that has a good public policies with massive migrations outwards, with social indicator levels that are tremendously negative, and unfortunately with negative trends also. Then, as a result of all of those incapabilities of building up a stage with a social contract and social equality, then it's a country that oftentimes have important political or social upheavals. And Chile is a completely different reality. This is the first thing that needs to be clarified. And the only thing that they seem to have in common is that graph, but realities are very, very different. Now, why will Chile, it's estimated that it will have a negative growth next year? There are some very specific things regarding the Chilean reality, the export structure, the political and the recent events that have taken place in the country. But we must keep in mind, this is the first thing that I want to say, that the type of state, government, public policies, political system that exists in Chile is totally different to that of Haiti. Having then clarified that, sure, we can start analyzing some of the specifics. For example, private consumption in Chile will have a drop because of a labor market that has lost its momentum, or also the disappearance of liquidity due to the withdrawing of the funds from the pension funds, financial conditions that are more restrictive for different types of loans, and this together with the high inflation that we expect will continue or will be high, will then not promote growth. And we have a pessimistic forecast in terms of investment. There are uncertainties due to economic and political reasons that you're well aware of, the uncertainty created due to the constitutional process that took place. But in this aspect, 2 or 3 days, we have some excellent news too. So one would expect that those news will also decrease a part of the political uncertainty and will imply an improvement, especially regarding the moment when this projection was put together. So we're going to take a look at that, and if that certainty has helped in private investment, and we might end up with better results. Now, on the external front, also with their commercial partners and the growth of China, which is such an important trading ally. China is the most important trading partner for Chile and for other countries too. And we can see that China is undergoing a growth rate of 3.3, which is the lowest in 4 decades, and that's another negative effect. So, in order to start closing this and to make a distinction between Chile and Haiti, these two economies are not equal. The reason as to why Chile will have the negative economic growth is because of the economic cycle and the elements that I have just mentioned. In Haiti, it's for structural reasons. So these are totally different realities, but they do have that element in common.
Thank you, Executive Secretary. Agencia Presa Latina has the following question. Except for some specific issues, most countries had a shrinking of GDP. What does ECLAC suggest in order to get rid of inequality and to have better jobs in order to have a different situation before it gets even worse? Well, growth rates are low, and that is why these are not good news. This creates an even more difficult environment for all social objectives, having in mind employment, reducing poverty and inequality. If we look at the past, re- recently in Latin America, we were able to reduce inequality, poverty, and informality in the region. That was from 2002 up 2010, 12, 13, the golden age of growth. And what happened during those periods? Some progressive countries wanted to take advantage of the boom, and they went into social expenses. But that was an environment that was favorable during those years. There was a very strong growth rate during those years. And that gave flexibility to fiscal management, allowing for the necessary investment to take place. Now, the bad news is that we have a world economy with low growth rates, and this is also reflected in our own structural issues. Our message, therefore, and I've already given you the numbers, is that these are extraordinary times that require extraordinary measures, strong pacts, a big consensus, not only nationally, but also in specific issues in the fiscal matters, social policies, reducing inequalities. The time is ripe for societies to leave behind the sleeping times. Even though the world economy is in this unfavorable situation, still there's much that can be done. A lot of room to move even under these circumstances. It's important not to say there's not much to do because the world economy is growing at 2 or 3%. No, we must take do what is needed to do in Latin America and the Caribbean. So the message is transformation. There is fiscal room. We've seen in Colombia, we'll see now in Chile if it works out. Tax reform, that's important. 1.5 or 2 points of GDP may sound like little, but it's a lot. We're talking about many, many millions of pesos or dollars that will be, if well used, may move the needles of inequality, of poverty, etc. Thank you, Executive Secretary. Paulina Bromwich from France Press. And the question is, it's the first time that we see this. And now, when do you think this process will reach bottom so that we may go back into the path of recovery in the region? Well, I don't want to monopolize the answers. Mr. Titterman, why don't you take over? Thank you, Executive Secretary. Well, thank you for the question. Not an easy question, as we just heard from our Executive Secretary. No, we don't have the magic wand to ask what's going to happen in the future. In truth, there is a slowdown. And next year, we are expecting slowdown vis-a-vis the growth of this year, 1.3. About a third of the growth is what is expected. And the big challenge in the region is how to go back into the growth path, leaving behind the traps. But this will depend on macroeconomic and public productive commercial and social policies adopted in our countries. So I would answer saying that the big challenge is how to go back, bring the momentum of into growth. And that depends on macro policies, I'd say. In spite of the macroeconomic restrictions, we should have the mid and long term in mind, minimizing the costs involved in growth when we have to adjust to restriction. That is the first element of the policy in order to go forward, leaving behind the growth trap. And this effort in macro policies looking into the future and searching for adjustments to minimize that impact must be followed by social policies with a social protection, with labor policies that also will give in more momentum, more hiring, with productive policies, also with gender in mind. And the care economy could encourage more growth in the region. And actually, the challenges of climate change, because of the investment needed, can be another way to boost growth. Thank you, Daniel. Amanda Santillán from Diario Financiero Chile. Comparing to the past, these projections are better for 22, but lower for 23. What are the factors behind this difference? Let's see. We came from an economic cycle that was extraordinary and unique. Pandemic, and also related to the war in Ukraine, the inflation, the disruption of value chains. This series of crises is something that hadn't happened before. Yes, we did have financial crisis, but that was specific, hitting the real estate sectors such as the United States and elsewhere. But that's it. But during those days, if you recall, China was growing 8 or 9%. And the discussion was whether the recovery was going to be an L or a W or whatever. But Latin America had a new kind of recovery, a quick one. And why? Mainly because of the boom in oil prices. Chile was demanding also all of the ores exported by many of our countries. Now, why 23? Unfortunately, will grow less than this year, partly because of what's not happening. We don't have the China effect right now. And also because of what occurred and what happened, there was a series of crises that hit us. A series of crises that left us with a very restrictive fiscal rule. So the maneuvering is very limited right now. And also, in having that shock, 6% was the average slowdown in Latin America. That is the highest slowdown that occurred since the First War and the Great Depression and the debt crisis and the financial crisis. So it's sort of a heart attack that we had in the economy in 2020. After the heart attack, the body, the economic organisms are in trauma, traumatized. They are having all sorts of symptoms, little fiscal space, a lot of inflation. And we don't have a China with a commodity boom. And Eurozone, 0.3% growth. They won't have a good year as well for 23. All of that tells us that that's why we will have 23. Now, what we saw right now is really something not normal. It's extraordinary. Once more, to go with the analogy of the heart attack, we had not the body, he didn't die, but the patient felt better because he was medicated. But he's not well, he just had a heart attack. And that was the rebound effect. So we cannot ask, why don't we continue growing as we did in 21? And 22, yes, we still have the rebound effect. But 23, that's when, unfortunately, we go back to normal. And that normal is not good. But that is why the structural matter is so important. ECLAC insists on this. We have a prolonged social crisis, education, and the social outlook talked about it. We have to work on growth, on inequalities. And a final reflection, things could go even worse. No country is destined to have everything on the rise. That's not defined. This is something that must be built. We have to work hard. We have to be serious, austere, pragmatic, realizing that things are not well, but if we don't do our job, things will get even worse. There is no bottom here. We can continue getting worse. Thank you, Executive Secretary. There's a last group of concern we just received. Last because of the time constraints. We have received many persons and many questions during this event. And naturally, we will answer all questions in writing, at least those that have not been answered here. In this last group, Yolanda Morales from Mexico asks, what are the factors that will make Mexico go into recession next year? And how will that affect remittances because of inflation and greater and more slowdown? I'd like to invite Daniel to answer that question. Thank you. We forecast for Mexico first slowdown, not a contraction. It's a slowdown in growth, and we expect that Mexico will grow 1.1% next year, and that is a positive growth. Very low, yes, as we heard. And here we find a great challenge: how to grow more in real terms. One of the things that explain this slowdown, naturally, as we just heard, the slowdown of the main trade partners. In Mexico, we're talking about USA, that also will slow down by next year. And USA is a great agent to demand the goods. So this is going to have an important role, and that is one of the reasons for that slowdown. And naturally, the negative effects of inflation. As we saw, it has a negative impact on wages. It also affects the capability to maintain domestic consumption that is very important for aggregate demand. And this is something that must be considered. And also the hike in interest rates will affect domestic demand because credit is more expensive. Investment costs go up. So here we have an impact, and the interest rates have gone up to face inflation, as has happened in the other countries throughout the world. And this is one of the reasons for what we expect by next year. Remittances. I would say that the remittances, if they have shown in this cascade of crises, has been resiliency. Remittance has maintained a good flow in many countries as well as in Mexico, though in Mexico the importance of remittance over GDP is lower than in other countries. But if the remittance shows the same behavior in the past, it should continue to be resilient and will also still continue showing a capital inflow towards Mexico. Thank you. Thank you, Danielle. Silvia Rodriguez from Millennium, Mexico. What elements are behind ECLAC's estimations for growth of Mexico next year? And what are the risks for the Mexican economy? Thank you. Well, I thank you for your question, and that goes along the same lines of what we just answered. The main risks behind the growth has to do with the dynamics of the global economy. As we see, the global economy is slowing down, and we see a big slowdown in the U.S. economy, and that certainly will affect whatever comes from outside. And as we had said, we also have seen the change in interest rates from main central banks and also including the Fed. That will continue to be high. They will continue to be high. We're showing also less appetite for risk and less access to international for financial markets. And that is a risk for Mexico and for the whole region when we talk about growth for the next years. And in terms of national and foreign investment, the hike in interest rates and greater volatility elsewhere can affect the investment for the next year. That's another risk factor.
Digamos, por el lado
Well, and also internally, if inflation remains and this impacts real salary and people's incomes and revenues and increases employment, obviously that has a internal consumption impacts, which would be another risk factor for Mexico, just like for the rest of the region. Well, thank you very much, Director Titelman. Laura Martinez from Semanario Universidad San Jose from Costa Rica has the following questions. What are the specific projections for the Central American countries, in particular Costa Rica, and what does the economic performance post-pandemic look like? In the graph that we had in the presentation and also in the report, you were able to see how Central America grew 4.2%, and the estimation is a decrease, but not as strong as in other countries, which is 3.03 in average. And the figures are 2.6 growth in 2023 for Costa Rica, 1.6 El Salvador, 3.0 Guatemala, Honduras 2.7, Nicaragua 2.1, Panama 4.2. Dominican Republic is not precisely Central America. It really depends on the definition, but still Dominican Republic is 4.6. So what happens here is the Central American economy, if you want to compare it against South America, is very different. First, because of the size of the economies, some dynamic sectors can make an important difference. Large economies like Brazil or Argentina, it does make a difference. Such large economies, even the Chilean economy, when compared against one that are very small, like the ones of Central America. And then also these countries have integrated with the United States. The economic dynamics depends on several sectors, and by far the United States is the largest market, and then the second one is the inter-regional trade, or maybe Europe, depending on the year. There's a lot of trade between the regions with a much higher rate than that of Mercosur or that of the Andean countries. So it's a growth rate that is 3%. I mean, you may judge, and it's not extremely high. One would wish that it were higher, but it's really such a mediocre or disastrous rate, and it varies by country. Now, there is one element that you can see the price of some exporting products that are cycled, the price of coffee, and some other aspects that these countries export and their economic cycles. But there is one aspect here regarding the growth. For some countries, is having an important benefit, and that is the reconstruction of the value chain. These are small economies integrated to the North American market, and this reconfiguration, which is not only an academic conversation, but it's something that's actually happening. There's an important amount of multinational companies that are investing, and some have found places to bring productive facilities that in the past used to be either in China or in other countries in Asia and the United States, and also the distance are all very well strategically positioned. If there is a good investment environment and if you have the human talent, that's also going to be important for the growth. And since the question included Costa Rica is one of the countries that is best positioned that complies with all of these requirements. Good investment cycles close to the United States, stability, important development of human talent, good positioning of information systems, universities in order to create the talent that is required by a lot of these multinational companies. So Costa Rica is in two of its leading sectors, and also a third one, medical devices, exports of services, e-commerce, that's a boom that they are experiencing. With the pandemic, instead of dropping, it actually spiked. It went up important growth rate. 2021, 22, medical devices, for obvious reasons, there's been an increase in the demand in all of the health-related topics, and Costa Rica has an important cluster there of medical devices, and also electronic trade, electronic commerce, because there's been a migration towards that world. So it's interesting. So I might want to provoke you by saying this, but Costa Rica does have a set of characteristics that are worthwhile studying, because there could be important lessons to be learned by other Latin American countries in terms of what it implies to position in some of these driving sectors that the ECLAC has always been recommending. Thank you very much. And as we have said, we are thankful to all of the colleagues that have joined this press conference and that have followed it with lots of dedication. We are on time, and we will address the questions that have been received. Gisela Salomon from Associated Press, Ivan Olivares from Nicaragua, Irma Cantizano Chang from The Economist from El Salvador, Alor Futuro Chile, Roberto Fonseca, also from Strategy and Business, Ivan Cajamarca, Jessica Martinez, also from the 24 Hours, among so many others concerns and questions that we have received, and we will be giving a response in a written manner through the contact point. So we will address these questions and we will respond in writing the questions that we haven't had the time to address within this press conference. Secretary General, the floor is open for a final closing remark. The most important thing, obviously, I mean, as an institution at ECLAC that always reflects upon these short-term and long-term topics, we are not happy to have to issue these reports where, unfortunately, there are so many figures that simply present the reality. But the important thing, and what we'd like to invite the societies and policymakers and governments to do, is that since this is such an extreme situation, we do require political willingness, and we do require the willingness of all the different sectors to negotiate, to come closer together, and to agree different transformational roadmaps on several topics. So our call is that this is an emergency, this is a development crisis, these are not normal times, and the optimistic reading of this is that Latin America has important assets, human talents, biodiversity. And we know how to do things when it comes to production. There is a startup, unicorns in several different areas. So this is not a poor region. What has actually happened is that the task has not been fully done. And that's part of the report. We can see how other countries that started from a lower level with compared against the social and economic indicators, they have done more than us. So their future is built collectively. The societies with willingness, with agreements, and with constructive behaviors. And that's what we would wish and what we would like to invite you all to do, so that in 5 or 10 more years, the situation is a lot better. Thank you very much. Thank you very much, Executive Secretary. We want to thank all of those who have joined us in this presentation, and we would like to thank the attendees, the members of the social media that have come to this meeting in order to make sure that this information can be disseminated to your corresponding audiences. The material is available, the document, of course, is available, and the public information unit is available for the mass media in order to continue with the follow-up of further questions. And with this conference is adjourned. Thank you very much.